Okay, hello everybody. Welcome to Korean Atlanta Mentorship, and today we're just going to do another review of Velocity Banking. But before we do that, let's take a look at this website for the Built Mastercard. So if you don't know what the Built Mastercard is, it's a card that rewards you and incentivizes you to pay rent payments. Okay? Now, here's the thing. I always say banks are like the smartest institutions on earth because they got the tallest buildings in every downtown in North America, but they don't produce an actual product like an iPad or a cell phone or anything like that. They just push around paper, right? But here's the thing. Even the smartest of us have a lapse in judgment. Like for example, the Built Mastercard. So if you don't know, the Built Mastercard is actually losing $10 million per month. And if you just kind of think, right, just do a little bit of thinking about why, it becomes obvious. Now, here's the thing. A lot of people are like, oh, Velocity Banking is a scam. Velocity Bank is a scam. But the bank, or Wells Fargo in this case, has accidentally created a credit card that encourages and incentivizes you to do velocity banking, right? Because this is a credit card that incentivizes you to pay rent. So you put your biggest expense, rent, on the credit card, you get some points, and then you spend that card in other things like, I don't know, food, gas, insurance, and all that other good stuff. And if this is your only credit card, guess what's going to happen? You're going to put your entire paycheck into it and take your expenses out and use this credit card as your main operating account, right? Like, no one has to teach you to do this. You just normally think, oh my goodness, like I'm putting all my expenses here, and then I'll just put all my paycheck in here, right? And now I might as well get rewards. And look at how much money they're losing, $10 million per month, right? So, why don't we? And here's the thing: setting up a credit card requires a significant amount of investment and infrastructure. And why don't we do this? Why don't we just ask ChatGPT, right? Can you estimate how much Wells Fargo would have spent to set up the built credit card? I'll just say ignore uh, costs after setup. Okay. $10 to $50 million, right? So you put, everybody wants an ROI on whatever product or they're selling. And so they spent 10 to 50 million. And if you're losing $10 million per month because you didn't understand, not even the bank understands velocity banking, you kind of, and here's the thing. I always say, if you're thinking about finance, don't think of it from the consumer's point of view. Always think about it from the lender's point of view, right? So you're losing $10 million a month because you're putting your entire paycheck into that line of credit, expenses out. And let me go ahead and read this before we go deep down or do a further review.
Estimating the cost of setting up the Built credit card by Wells Fargo would involve considering several factors. 1. Product development. This includes research, design, and creating the structure of the rewards and benefits, e.g., Built's points system for rent payments. This could involve multiple teams, including finance, legal, compliance, and marketing. For a complex card like this, development might range from hundreds of thousands to millions of dollars, depending on the scope and time. 2. Technology infrastructure. The back-end systems for processing transactions, managing rewards, and integrating rent payments likely required significant investment. Wells Fargo would need to integrate with both existing payment processing systems and any partners involved in rent payments, such as real estate platforms. This could range from $1 million to $10 million or more, depending on the complexity. Number 3. Partnership agreements. Establishing a partnership with Built, a fintech company, and securing exclusive agreements may involve negotiation costs, legal fees, and potential upfront payments or revenue-sharing deals. Depending on the terms, this could be anywhere from $500,000 to several $1 million. 4. Regulatory and compliance costs. Wells Fargo would need to ensure that the built credit card complies with financial regulations, e.g., fair lending laws, data security. Costs in this area could be substantial, involving legal teams, consultants, and potentially new processes or systems to ensure compliance. This might range from $500,000 to several $1 million. 5. Marketing and launch campaigns. To promote the built card, Wells Fargo would have invested in marketing, advertising, and public relations. This could include digital campaigns, TV, partnerships with influencers, or major events. A full-scale campaign could easily run $5 million to $10 million or more, depending on the scope. 6. Vendor and third-party integration. Built's model involves paying rent via the card without fees to landlords, so Wells Fargo may have incurred costs related to integrating third-party services or platforms to manage this feature. Given these components, an estimate for setting up the built credit card could range anywhere between $10 million to $50 million, depending on the scale of development, legal complexities, and marketing efforts. This estimate excludes ongoing operational and customer service costs, which would add further expenses.
Folks, if I spend $10 to $50 million for any, let's say, a business investment on a business, and I was losing $10 million a month, I think I'd be crying. And it says, doesn't plan to renew the contract, which is scheduled to end in 2029. So they got 5 more years to go to lose $10 million a month. That's pretty bad. So, all right. So let's go ahead and review what could probably be the main source of their struggle, okay, which is Velocity Banking. So here I have my budget. And so what is Velocity Banking? All it is a debt payoff strategy where you put all your paycheck into a line of credit, kind of like a credit card, like a Bilt MasterCard. You pay all your rent, all the good stuff there from the line of credit, and then you take your expenses out and you use your line of credit as your main operating account. So in order to do Velocity Banking, we only need 2 things. Number 1 is a budget, and then number 2 is a line of credit as our main operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again, right? So I got different types of lines of credit. You take a look here, $280,000 home equity line of credit. Take a look here, $15,000 personal line of credit. I got so much credit. I have spreadsheets to actually keep track of every single payment per month, the limits, and what's my what do you call it? You know those graphs where it's like you show the usage from time to time. I got all that, right? And so if you want a line of credit, here's the moral of the story, okay? You need to get it before you need it. And because banks don't lend money to people who need it. That's where they're smart, right? They understand that part. They screwed up here because they didn't understand that they created a card that incentivizes to do what we're going to teach here, right? Which is Velocity Banking, right? 10 million a month. A lot of people say, "Hey, Velocity Bank's a scam." Well, why is Wells Fargo losing 10 million a month on the Bilt MasterCard? The card that incentivizes you naturally just to put your entire paycheck into that line of credit or into that credit card, because Velocity Banking does work, right? Well, I guess I shouldn't say that because I don't like to say if it. Well, I could say it works. I just don't like to say it's the best, just because I want you to come to your own conclusion, right? All right. So we got the budget. We have that, and we'll assume that we have a, I don't know, $40,000, 40. Some people say this is unrealistic. Well, unrealistic to you, because I got over $500,000 in lines of credit, and a lot of people, they kind of ignore my I don't want to say expertise, just my experience, right? I know what they're looking for. This is why I every time I apply to a bank, I get accepted maybe about 50% of the time, and then I get rejected a few times, and then I get over $500,000 lines of credit. But we'll say for the purpose of this demonstration, we have $40,000 in a credit card or a credit limit or a line of credit limit, okay? So now let's just go ahead and copy most of this, same income, okay? Same expenses. But, okay, here's the thing that's really important, is that we don't have any savings. But we have something called cash flow, which looks like savings in the beginning. So our goal is to maximize the cash flow. And how do we maximize the cash flow? Cheat code, move all of your short-term loans, like the ones that are like a year or less, or credit cards that are higher interest rate into the line of credit. That's how we first start. Okay, so if we go ahead and move these two credit cards, that's 23 grand. So that'll be 23,000. And then guess what happens to these payments? 0, 0, right? So now what we're going to do is once we've set up our line of credit as our main operating account and move our debt there, we're going to put our entire paycheck, the entire $6,000, into the 23 grand. Right after we put the 6,000, two things are going to happen. Number one, the minimum payment is satisfied, so we don't really care about that. Number two, the interest is minimized because this one has a lower interest rate than the credit card, but also you're minimizing the average daily balance, right? When you put your entire credit card, and that's how the interest is calculated. Let me just show you here, right? So the next month's balance is the previous month's balance plus the previous month's interest minus this right here, 1754.23. Okay, and then what we do is we take, okay, the average daily balance right here, average, and we multiply it by the interest rate, which is 0.085. Okay, now take a look at this. You might be thinking $1,800 of interest. That's insane for this 8.5% interest rate. But hold on, because you got to divide by 12. So they always quote the interest rate annually, but they divide by 12, right? And so the interest that we pay is only $156. Okay, so think about this. We went from 900 to 1700 minus 100 for that 1 month, and we maximized our cash flow by putting your entire paycheck into the line of credit. Now do you understand why Wells Fargo is crying? 10 million a month. Everybody doing this on the Bilt MasterCard. You put your rent in there, your biggest expense, put a little more of your expenses, gas, groceries, all that, dump your entire paycheck, maximize cash flow, right? All right, so let's go ahead and copy all of this. And then you can see that if you just copy the formulas, this gets paid off in about 14 months. Okay, 14 months. So now let's go ahead and write this as a milestone. 14 months. And how much debt do we pay off? 23K, 23K. And then we got the auto loans, 2 auto loans, and the mortgage, right? And so what we're going to do is figure out which ones do we pay off first, the auto loan or the mortgage. The mortgage has the highest balance, so this one has the highest interest rate. This one has the lowest balance, and this one has the highest payment. Of the 2 auto loans, which one do we get rid of? Okay, and I already know just from experience that I'm going to get rid of auto loan 2, and I'll tell you why. We have to think about cash flow ratios, right? There's a thing called the cash flow index, okay? So if I pay off this 15 grand, I get $300 a month, right? $300 a month. And how much is 1475 divided by 300? How many times is that? Let's just do the quick math. 1475 divided by 300. That's about 5 times more. So if I do 15 times 5, right? 15 times 5, that would be 75,000, right? So look at the ratio. I have to pay a lot more for the mortgage to get this $1,400 back, whereas for here, I think I'm paying like 5 times, or if I pay off this auto loan, I'm getting 5 times bang for my buck. Hopefully I explained that right. But it's about bang for your buck, right? You don't want to pay off the mortgage first, you want to pay it off last. Because you focus on paying on this $350,000 mortgage, look how little cash flow you get. You pay this 15 grand auto loan, you get 300. You get 300, right? It's a lot more bang for your buck. Okay, so let's go ahead and show how we would determine how to pay off the auto loan and the mortgage. So let me show you this. This is my loan calculator, and if you have any financial calculator, I think they call it time, money, value calculator. If you have these 3, what do you call it? Factors: original balance, interest rate, and the loan term. You could automatically calculate the payment and then the balance. So how much time has passed? Okay, so 14 months, right? So 14 months, it's 141414. Whoopsie, I screwed up. Okay, so look at this cash flow index, and all it is a formula of the balance divided by the payment think of this as a ranking system. The lower the rank or the lower the number, that's the one you want to pay off first. Yeah. So the lower, so this is the lowest, and usually anything under 50, we're okay with paying off, and anything over 100, we don't want to pay off. Especially we don't want to move into line because if we move it into line, not that much cash flow, and you might hear on the internet like, hey, just move your loan to a line of credit or your mortgage to a line of credit. And that's a very nuanced statement, and you can't say that for everybody, okay? But let's go ahead and do this and take these two loans and move them to the line of credit. So that's G2 plus H2, right? No, G3, right? So 31 grand, 31 grand into the line of credit. So all we got to do is move these, right? So let's move this right here, and I'm going to copy and paste this, and I want to just highlight this right here, okay? And so now let's go ahead and move this. So plus 31058.61. Okay, and once we move those two auto loans into that line of credit, immediately your cash flow increases, right? So 0, 0, and now our cash flow is at 2500, 2524.39, right? That's our cash flow, 2524.39. So I'm going to go ahead and update our numbers, right? So let's go ahead and do that. And so after this month, when we move it into the line of credit, so let's go ahead and update this number, which is now 2524.39. Okay. All right. So now let's figure out how long it takes us to pay off two auto loans. Okay. So it's going to be about 27 months right here. And so what's 27 minus 14? 7 minus 14. Ooh, 13 months. So not bad. Well, a little bit more than a year to pay off two auto loans. That's really good. Okay. So 27 months. And then this is going to be 39. So these two auto loans are 39K. So it's 23 plus 39. Okay. So that's going to be 62K. 62K. All right. So 62K. So we got that. And that's our next milestone. And then now we go ahead and think about paying off the mortgage. Because why is it important to pay off the mortgage? I'm going to tell you why. Because it's a 30-year contract, and they want you to make the small payments so that the interest accrues. It's the same thing how student loan, what do you call it, deferral, or what do you call it with the income-based student loan programs where they said, hey, we're going to lower your payment, and then like 10 years later, the balance goes from 70 grand to like 120 grand, right? Because the banks are not stupid. They like low payments. They love it when you don't put your entire paycheck into the line of credit. That's why mortgages have huge commissions and are big money makers, right? So let's go ahead and take a look here. And if I type in 360, right, look at all this interest that accrues, 181,000 for this $350,000 loan, even at 3%. Okay, and that's unacceptable to us. So we're not going to do that. So let me go ahead and go back here and figure out what month are we in? We're in month 27. So let me do this. Okay, month 27, and now we've paid. So the balance right now is 333,000. So at this point, like with this 333,000 balance, what do we do with it, right? Do we just keep making the monthly payment? Because there are people who are going to argue that, but to be honest, I'd rather, because paying off debt is guaranteed, but making a return on investment is not. Like I'm afraid to put money on the stock market because I don't know if I'm going to make that money back, right? But with real estate investing, the beauty of it is that you can always buy the property at a discount. So if I decide I want to fix and flip homes in California and all the homes are like 1.2 million or 2 million, I just need to buy it at like 800 or 700,000. And usually when you got a good deal, people will lend you the money, right? But with stocks, no one's going to lend you the money to buy stocks. The banks don't lend you money to buy stocks, do they? I don't think they do. All right. So although you can get asset line of credit, like so you could give your stocks and equities and all that as collateral for a line of credit, and even your life insurance and your home equity. Of course, we always talk about that. But my point is this, okay? My point is that I prefer to pay off the debt because if I don't pay it off, you saw all that interest accrue. Okay, so there's two ways to do this. Number one, okay, and not a lot of people talk about this, is you can directly, and actually let me copy the balance here into the other sheet. This is the balance. Okay. There's two ways we can do this. We can put this entire $2,524 into this 333 balance after every single month, including the mortgage payment. So this is what we call an extra payment. Okay, so this is what I think of extra payments. Okay, so extra payment, this is what is the equivalent for me. So a lot of people will argue this, all right? Well, if you put this 2,500 something dollars into that line to the loan directly as an extra payment, look, you don't have to do something silly like use a 10% or 15% or 30% credit card. That's dumb, okay? And so this is the way that I think about it. That this is like buying a Netflix or even a gym subscription. You ever notice that gyms don't actually expect you to go because they put it at such a cheap price and then make it inconvenient for you, right? So the way that I think about it is like a Netflix, right, subscription where it's the cheapest price. We'll say it's $1 a month, okay? Well, we'll just do one right here. $1 a month. $1 a month. But you can only watch it from 1 a.m. to 6 a.m. or 5 a.m., right? You got viewing restrictions because this is the cheapest plan. Okay, this is the cheapest plan. That's what an extra payment is. Whereas if you overpay with your line of credit, oh, we'll just call it overpay. You call it chunking. You call it chopping up your line into pieces or loan into pieces the line of credit. We'll say this. Even though it's at a 10% interest rate, what if, okay, this costs you $1.10 and you can watch instead of 1 a.m. to 5 a.m., you can watch it anytime, right? That's what the line of credit is like to me, okay? So what is the benefit of the line of credit? It's the fact that you're actually going to do it. Nobody does this. This is the default. Everybody has the ability to watch Netflix from 1 a.m. to 5 a.m. And it could even be free. It's a free option. Nobody's going to do it. This one might cost you some money because you are using an 8 to 10% or 15 or 30% line of credit to do this. Okay? But the difference is you're actually going to do it. When you do a $10,000 chunk, when you have a credit card, right? And it's a $6,000 chunk into the credit card and you're putting your entire paycheck in, what's the likelihood, just kind of like with the Bilt MasterCard, that you're going to actually do it and put everything in there? People don't think about that, right? This is why a lot of budgeting and finance all fails. And this is why I like Velocity Banking because it's simple, it's easy. I don't even have to do the spreadsheets to think about this. All I know is I'd look at my bank's website. Oh, I'm putting the entire 6,000 in. I'm doing that, right? And so the most important thing is not the chunking amount. It's have we optimized our cash flow and is the mortgage the last debt that we're paying? The more that you chunk, the more that you pay, but it's going to be almost minimal just as long as you have enough cash flow, right? That's what people don't think about, okay? And I honestly think that the paying off the mortgage part is oversold if you're not looking at velocity banking as a holistic strategy. That's where people go wrong. I mean, I hear a guy named Chris Noggle talk about this all the time, where people don't know how to explain infinite banking, and I get where he's coming from, right? Because he's like, well, no, it's not just a whole life insurance, right? And I get that because that's the way that people explain velocity banking. Oh, it's just a line of credit. It's just a line of credit. That's not it. It's a holistic strategy and philosophy, and that's how you have to think about it. So let me go ahead and pull out my velocity banking calculator. Give me one moment. There we go. We got the velocity banking calculator right here. And you just fill in the numbers. That's what's so great about it. You just kind of move money into the line of credit, dump all of it in, pay it off over and over again, and you could see from 8 that our mortgage is paid off in about 7.9 years. That's pretty sweet. That's pretty sweet, right? So, all right. So I don't even know where to go from this other than I can't believe Wells Fargo is losing $10 million. Actually, final step. Let me go ahead and copy this. And let me go ahead into here, into the other spreadsheet, and put in 7.9 years. So 7.9 years, so it equals 27 plus 7.9. No, 27 divided by 12. plus 7.9. Okay. So that's 10.15 years debt free. Okay. So one of the things that we have to be really careful about in real estate, and this is really emphasized in real estate investing, so you might have seen like the Renatus logo in the Velocity Banking Calculator, which is where I originally learned all this from, um, is that we need to learn how to buy things at a discount, right? So when I take a look at this $350,000 home, or the loan is $350,000, so that's 80%. So there's probably going to be what three? Actually, what's 20% of? I don't even know how to do math. Actually, let me just do this. 350 divided by point 0.8. Okay. What? Divide. Okay. So that's a $437,000 house, right? And these houses at the 400 to $500,000 homes, I honestly think that they're going to make you really poor because it's deceptive. Like me, as a real estate investor, I want, like, I don't care about high interest rates, right? You give me a property with the same monthly payment with a high interest rate and a lower purchase price, and a high purchase price and a low interest rate, I'm always going to take the lower purchase price because that's how we make more money, by buying it at less than market value. But if we buy it at market value, the purchase price is always mandatory, the interest is optional, right? And so whenever I see a $350,000 home, what I know what the average American is seeing, they're seeing that low monthly payment, okay? But it's so much harder to pay off the home. Like I don't like that I'm seeing, and this is just me and my bias, I'm seeing 10 years debt free, because every other simulation where I do this, it's like, oh, you paid off, you're debt free in 7 years, including your mortgage, right? And why? Is because many times we work with $200,000 loans, which to me is reasonable. I'd rather have a $200,000 loan at 6% than $300,000 loan at 3%, right? I don't want that nonsense. Okay, all right. So that's it for today. I hope now we understand why the bank Wells Fargo is crying, because they created a credit card that allowed them to, well, I don't want to say allowed them, that incentivized their consumer to do what we're doing here, which is entire paycheck into line of credit and take your expenses, right? And just by doing that, they're losing $10 million a month, including all the rewards points and all that good stuff, right? So even the best of us, like the banks, who are the smartest people on the planet and the laziest people on the planet, screw up sometimes. Okay, well, it's Crane Atlanta Mentorship. Have a great day, and we'll speak next time.